Marcy, are you familiar with sequence of returns?
No, but I am familiar with sequence of events.
Same thing.
Okay.
Well, I guess kind of the same thing. But you know what? It's not something you should have to know about. It is way too complicated to try and time. I'm Mark McKay.
And I'm Marcy McKay.
And welcome to Sage Smart Solutions. Please join us weekly to learn new and exciting ways to protect your assets and retire tax-free. I got to remember to do that. Anyway, so sequence of returns means that how the stock market's volatility, the incredibly volatile stock market, whether you've got a 60-40 blend or 60-30-10, or you think you've got the great loaded mutual fund that some radio guy told you to buy, if you do it at the beginning of a bear market or a market correction, it greatly increases the likelihood that you're going to run out of money before you die. So
you sort of start behind before you even
and you can't
started.
catch up.
Yeah.
It's just too risky. So we're going to take a look at some of the numbers. I know a lot of people that who haven't really experienced, maybe they remember the market crash of 2001.
But they haven't felt the pain.
Yeah, they didn't have any money at the time. They were 26 years old. And so they didn't really see how long it can take to get back to zero.
Right.
They don't remember what it's like for the average American to be afraid to open their 401k statement.
Yeah.
And in 2001, that was basically how you found, I guess a lot of people are still going on and logging on, but some people had to use dial-up to do that.
Yeah,
So
absolutely.
It just really shows you how the math is too risky with their way. We're going to show you ways that can take longevity risk out of the equation. We can deal with inflation. We can take tax risk out of the equation.
Okay.
So
show us the
let's
numbers.
go look at the numbers and see what it actually took to recover from some of the recent market correction. When I say recent, I'm going back to 1929. So.
You're also going to 2008, which
Yeah.
truly is recent.
So let's go take a look. So what I wanted to do is look at some of the actual numbers. I think that a lot of people, if you're not over 40, you might not remember what an extended bear market looks like. And with all the fiscal stimulus, the trillions of dollars that were just manufactured to keep this economy afloat, really going back for the past 20 years and with interest rates going to almost zero over that same time period, the numbers really got a little bit out of whack. And especially if you look, I don't know how many people remember right before the pandemic, but we had a bear market. The markets crashed, oil futures went to zero, but then it bounced right back. So I think that skewed a lot of people's perception of how much risk is out there because, and I think that's why so many people got caught off guard with this most recent market correction. And because they thought, when we see volatility, it always bounces right back.
Right.
But that's not always the case. Let's go back and you can see some of the market crashes throughout the history and how long it took to get back. We'll look at the Great Depression. It took 12 years just to get back to zero. If you had money in the stock market then.
That's devastating.
Yeah. Well, let's go to the ones that some people
Yeah.
might remember. They may not have participated.
2001, I definitely remember.
2001. That's where we got smart. And it was in 97 and 98. You had big pullbacks, kind of in the fourth quarter, especially in tech stocks, because remember that's when the .com craze was, and what it did is it pulled back in 97, bounced back. Pulled back fourth quarter 98, bounced back. Pulled back fourth quarter of 99. All the people, mom and pop said, "Uh-oh, it's going to bounce again. Let's go all in." And that's when it crashed. That's where we had an extended market correction. Took 8 years to get back to zero. I remember I'd been in this industry for a long time, and one of the caveats that or not really a caveat, but one of the things that your traditional stockbroker clung to. There's never been a 10-year period where the stock market was down. Well, from 2000 to 2010, the S&P 500, didn't go up. So,
right, it was like flatline.
It went down a little bit, so it's one of those things. Stock market's never had a 10-year period where it went down until it did. So. Educate yourself. Let's look, after we bounce back from the .com bust, We had the Great Recession, which was, the mortgage crisis, the Big Short. It really showed you how much risk is out there because Wall Street has leveraged itself to the hilt because that's what they do. Why not? If they're going to be bailed out when they fail,
right?
Why not swing for the fences
and gamble with your?
Yeah, that's the other thing. They're not playing with their money.
Nothing to lose.
And if they have a quarter where they lose 72%, they get fired. They go down the street and they opened up a boutique hedge fund.
Right. To fail.
So anyway, I just wanted to show that bear markets can be real and they can be devastating. We're going to talk about how you had a great, or not you, we had a great video called, you're on the cover, so it made me think of that. It was dollar cost ravaging. So if you haven't seen that, I'm getting really good at this. I'm going to put a link. I don't know left and right yet.
Either there.
I'm going to put a link on there to that video. But if you want to see why it's so important to time the market correctly if you're going to pull your retirement income from that. The bad news is nobody can time the market correctly. It doesn't work on a regular basis. The markets are too efficient. So let's go back and look at some of the numbers of why the Wall Street method of putting all your money into a tax-deferred account, riding out the ups and downs, hoping for that 6 to 8%. You're not going to get that 12% that some of the talking heads talk about. They'll talk about how you can find one that did 12%. They can't say that they can find one that will do 12%. We can show you plans that are structured to make 10, 12, 15, 20% without stock market risk, without having to worry about what they call the sequence of returns, which basically says if you retire and a bear market occurs anytime in those first few years, it's bad news. All right, let's go to the chalkboard. All right, so we're going back to the handy dandy chalkboard here. I apologize if we've got any glare. I'll try and watch for that. But we wanted to show one more time, and if you haven't seen it, go back and check out the retirement plans that don't suck video. Or the most retirement plans suck.
Right.
One of those to get the basis of what we're talking about. But we basically were talking about if you wanted to use the Wall Street way of retirement planning and income distribution, why it's so bad.
Yeah, I was about to say, AKA sucks.
Yeah, so we talked about how with their way, if you wanted a $100,000 income in retirement, you have to have $2.5 million in your account. Now, if that account's like a 401k or an IRA, then that $100,000 is really going to be about $76,000 after taxes to you. So, you built up this giant bucket. But let's look at that.
That is a giant bucket.
It's a big bucket of money. But guess what? Their way, there's a pretty good chance it's not going to last, especially if your sequence of returns is bad and you retire at the beginning or a bear market happens anytime in the first few years of your retirement. So when you're pulling money out of it, let's say you've got your $2.5 million. Running out of room. Pulling your 4%. 0.04. So that's $100,000. So now, how much money do we have in this account?
Oh, gosh.
$2.4 million. Let's say this was January 1st. How much do you have in your account now? Not $2.4 million because the market's gone down 20%. So, what is 2.4 minus 20%, which would be about 480,000. So $1.92 million. Dollarinis. So we started out with 2.5. We pulled out 100,000 because we used that 4% rule. That's what Wall Street preaches. That 4% rule means there's only a 60% chance you're going to run out of money during retirement. But what happens if we do this at the beginning of the bear market? A lot of things, and none of them are good. So let's look at what happens if you have a market correction when you've started your retirement account. And you're feeling pretty good. It's January 1st, 2022. You've got that $2.5 million that you were planning for, that your guy said, this is the number. You remember when Fidelity used to have that god-awful, what's your number? And you followed this little... But they don't have a plan to turning that into income that is reliable and tax efficient. So you've got $1.92 million at the end of the year.
That hurts.
That hurts. So let's say it's 2023, and this is where we finished out. I can't pull $100,000 anymore because that's not 4% of 1.92 million. 4% of 1.92 million is 76,800. So their way, your whole goal, your whole reason you had a number was so that you could have a retirement that, allowed you to enjoy yourself, allowed you to spend your retirement dollars and live your life. But you just got a pay cut from 100,000 to 76,000.
And pay taxes.
And guess what? You still have to give 24% of that to the IRS. So what do we have at the end of the year? I'm going to need some calculations here.
Okay.
What's 1.92 million minus 76,800?
Oh my gosh.
So what do we have left? After the market correction, after we pulled out what we need to live on, because our sequence of returns was bad, we have 1,843,200. Still doesn't sound bad, does it?
No, but I'm still
But
not pleased.
But you started off with 2.5.
Right.
And you have 1,843,200. I'm gonna get a clean sheet here. So what was that number?
1,843,200.
200. So let's say the markets bounce back. So let's say they go up 20%. So Wall Street will tell you, oh, well, over 2022 and 2023, the markets average, they were flat. Going up 20% after going down 20% does not get you back to zero.
Right.
You're still in the hole. So what's multiply that times 0.2? So that will go up. So add that to this. I should have just written all these numbers up. So add that to... So, big market bounce back, say in the second year. We made $368,000. So that sounds pretty good. We had a great year. But we are now at
$2,211,840.
Sorry about my handwriting. We have this great plan that all these, MBAs from Wall Street put together, charge you a lot of money for. You started off with $2.5 million. You got to pull out $76,000. And now you've got $2.2 million. So you're down almost $300,000. So you just imagine how this looks when you have 3 or 4 bad years. We talked about how, the last market correction took 6 years. The one before that took 8 years, 12 years. Their way is too risky. Let us put together a plan for you that takes this uncertainty. We don't have to worry about taxes. We don't have to worry about market corrections. We don't have to worry about a sequence of returns. We just put the numbers in there. We let it go to work for you. Let you retire tax-free. So if
more stability, more flexibility, because every scenario you've shown here doesn't account for life happening. You know,
100% ours is more flexible.
Right. You know, someone's been diagnosed with cancer. We need money right now.
Well,
I want to pay for my granddaughter's college education. I can't do it with this. I mean, just those sort of things about real life.
Right. And that's the other thing is that we structured these to show, you know, okay, you can pull $94,000 a year tax-free out of this starting at age 72. But there is a big pool of money here that you can access tax-free. And when I say you can access, let's say that your $1 million is in the plan and it's earning 8%. The beautiful thing is if we borrow against this tax-free, let's say we take out 100,000, our 1 million is still earning 8%. Now we're going to pay a little bit of interest on here, but it's going to be less than 8%. So we're making that beautiful arbitrage, getting that spread there. So,
well, yeah, getting more bang for your buck, arbitrage.
And with a whole lot less risk than the Wall Street 60-40 split. Put it in the, you know, we'll use the 4% rule. That's their brilliant income distribution plan is, we're going to run 70,000 calculations and figure out which one has the least likelihood of running out of money.
Yeah. Kind of sounds like Las Vegas gambling to me.
Yeah.
With my family's financial future.
Well, they call it Monte Carlo bootstrap simulation. So, you know, Monte Carlo.
Yeah.
It's just a classy Vegas. Anyway, if you would like us to put together a plan for you, watch the Masterclass. It's 40 minutes long. Protect your assets and retire tax-free. You will learn something about leverage, infinite banking, compounding,
and
taxes.
better ways of retirement planning for your family.
So, you know, let's get the ball rolling. Reach out, watch the video, and then set up a strategy session. We'll spend 30 minutes on a Zoom or a phone call, and I think you'll be impressed.
See if it's a good fit. Yeah.
All right, everybody, have a great week.
Thanks.